So now it's more of a question of how long will this liquidity last that's in the market. We are back and Italy was frigging amazing. My wife surprised me because this was kind of a birthday gift. And yes, today is technically my birthday, so happy birthday to me. We had friends and family join us in Italy, which was unbelievable. We made pizza in Napoli. I had the best pasta I've ever had in Florence. And maybe the best sandwich in the world is in Florence as well, as freshly cut prosciutto and freshly made bread and just fresh ingredients in general is what makes Italy so friggin' special. But I know you didn't come here to hear about my story in Italy. We're gonna talk about some finances, but before we do, I've been really having a hard time on where to take this channel. There's just so many different things I want to do and show and share. And so my wife and I are creating a second channel, which I'll leave in the description. We're going to start dropping videos over the next few weeks, so give us some time. But please subscribe if you're interested in our journey through IVF, dieting, and the stresses of being newlyweds. So first things first, I want to talk about market activity and really where we've been going over the last few years in the stock market. Now, it all depends on where you start and where you finish because everybody's story is going to be different. And when we really look at the overall performance of the S&P 500, not just the NASDAQ and not just the top 10 names, it's been a tale of two stories. As most of you know, I did nail pretty much the top of the market in 2021. But when we look at where the market is today as a whole, the S&P 500 as an index, we basically have been in choppy waters for over 2.5 years, and it's been frustrating if you haven't owned basically the top 10 names that have outperformed and where all the money flow is going. Had historical money sitting on the sidelines over the last year, getting nearly 5.5% risk-free, and after this recent rally, we're starting to see the FOMO take place, seasonality. All this has been in the description I've been giving over the last few months here. I said that I think we can hit new highs, basically just below 4,800. I think we can reach these levels, and I think come the end of January, heading into March timeframe, we're gonna see higher risk periods take place. As seasonality is going to wear off, the consumer is drying up. As people are spending less money, there's going to be a less need to hire people. We're also starting to see the adoption of AI, which is starting to replace people's jobs. I think you can just walk into a local McDonald's to see you probably don't need as many employees as you once did. Now, I want to make it clear this is definitely my opinion, but I never fight the facts. And the facts are that every time the Feds try to navigate a soft landing, it always feels like it's going to be soft and things are going to land nicely. And then something absolutely breaks that nobody saw breaking. And there's no question we're starting to see a broadening rally here. To me, this is just a lot of money on the sidelines, playing catch up, the seasonality, and the optimism going into a new year and an election year, which you never want to bet against the election year, but I do think by the end of 2024 and somewhere in the middle, it's going to get frothy here because, well, it kind of just has to at this point in time. Government spending is absolutely out of control. When we look at total public debt versus GDP, we're reaching astronomically high numbers that are very, very scary. As most of you know, Fitch downgraded US debt, so the writing's starting to come on the wall here, and deficits are growing at a much faster pace here. We're talking about the last quarter adding another $1 trillion of deficit. This is just ridiculous, ridiculous numbers. And we're seeing that government spending does align with stock market performance. Let's think about what recently has outperformed. Everybody's talking about NVIDIA, everybody's talking about AI, and it's definitely been the chip makers that have had a substantial rally from the recent lows. And what has passed? Well, the CHIPS Act has passed. A lot of these chip companies are going to be getting government money, and that's just stimulus hitting the economy, and it hits in the stock market as well. But what happens when government spending stops or we have government debt crisis hit? Well, just like what happened when the bank crisis happens, we see that stocks take the escalator up, but the elevator down. Companies can go bankrupt very fast and things can turn on a dime. So I'm starting to see smoke here, and this is why I'm taking profits now. But it's not just the downgrades, it's not just the cost of that debt, and it's not just the fact that the government can't seem to stop spending. Yes, this is a long-term problem and is definitely going to lead to a debt crisis. But the signal I'm paying attention to is definitely the 3-month to 10-year treasury. I know I've illustrated this before, but just to kind of run through it again, we get the inversion, then we get yields normalizing, and that's when the clock starts ticking for a recession. Once again, 2000 to 2001, we get the normalization of the yields, the double dip bottom, and then boom, we're in a recession. Same thing in 2006 to 2008, double dip bottom. We come out, get normalized levels, and in a recession. Even during COVID, 2019 to 2020, call it, double dip bottom in a recession. And here we are forming what I believe to be another double dip bottom. And so this is where a lot of the dynamic is getting confusing for a lot of investors, because people are thinking that everything's in the clear, everything is fine. And when we look from a broader perspective, when we take the stock market momentum out of the equation, when we take the fact that there's still a lot of liquidity on the sidelines jumping in and getting that kind of euphoric behavior, when we take a look at the actual fundamentals of how the government spending is going, the debt to GDP, the inverted yield curve, the only thing that will stop us from going into a recession is if we have an unexpected amount of growth. And this is where the divergence is taking place with the bulls and the bears, because the bulls believe that growth is actually going to be very strong, and bears believe that the projections of future earnings going into 2024 are way too high. And I'm on the sideline saying that somewhere in the middle is probably the truth. And if we go into the middle, then that means that this market's expensive, trading at 22 times earnings. I think we need to be probably closer to 16, 17 times earnings. And if yields start approaching that 5% again, and I think we have to discount it a little bit more. We're sitting at 23 times earnings in a picture that's starting to look a little frothy going into 2024. We've had a huge rip off of the recent bottom. We're going into a period where US debt is getting downgraded. Less people are buying our debt, but we're issuing more debt, which to me is probably going to be a problem going into 2024 when we hit another debt ceiling crisis. And we just keep issuing more and more debt. And the only way to really get out of this, in my opinion, is actually having a recession, a full-blown recession, maybe even going into a depression. Now, before you think I'm crazy, listen here. The reason why I'm saying that is the government needs rates to go lower. They cannot afford the deficits at these higher interest rate amounts. So they basically need a global depression to take place and for all that money to flock to US Treasuries, once again, lowering the yield and them to take on and refinance debt. If we do not get this scenario, in my opinion, and rates remain elevated for that much longer, I see massive problems with commercial real estate. I see massive problems with bank losses. I see massive problems with government spending. All these things do not lead well, because it's really, the S&P 500 is really turning into the NASDAQ 100 when we look at the weighted average on these stocks. Microsoft, Apple, Amazon, Nvidia, Alphabet, Meta, Tesla are pretty much carrying the majority of the weight, which do carry the majority weight of the NASDAQ 100. This has been an unhealthy rally, and yes, while it's broadening, the broadening to me is based off of seasonality, not actual earnings growth. And so where the rubber meets the road is definitely going to be probably closer to the second quarter of 2024, and I definitely believe that there's going to be some problems coming in the first quarter of 2024 that's going to start showing themselves. Mainly consumer spending, I think, is going to be the big thing that's going to start showing itself, but also banks not getting earnings power is also going to show itself, because when we think about how banks make money, they need to be lending money out, and they are absolutely not. There is definitely a liquidity crisis around the corner here. And yes, there's still a lot of money on the sidelines jumping into this market, causing a euphoric top. But in my opinion, the price action is not telling us what's really going on in the economy or what's really going to happen with government spending going forward, because there are some big problems here. So now it's more of a question of how long will this liquidity last that's in the market. And I do believe it's drying up, but I do think we have a little bit more euphoria left. As I stated, I would not be surprised to see 4,800. How much more do you want to go? And are there major problems around the corner? And I believe the answer is yes. There is major problems around the corner. We're seeing loan defaults pick up. We're seeing government spending pick up. We're seeing government debt getting downgraded. So all these things are just starting to happen now, and these things take time to play out. The market is in a euphoric stage right now, and there's still a lot of liquidity propping this market up. Once that liquidity dries, we will get a repricing in stocks, in my opinion. As always, guys, this is my outlook. Hopefully everybody enjoyed, and we will see you in the next one.